Hello, welcome to the Landscape Group End of Year Tax Planning for Breweries webinar. We're excited for you all to join here. We're going to give it a minute or two here to let everyone pop in. If you have any trouble with sound or anything, let us know. There's a chat box on the right-hand side of the screen that will allow you to write any questions you have, or if you see any technical issues, let us know there as well, and we can let you know that. So we'll give it another minute here to let people come in. Just want to welcome everyone here. My name is Josh Lance. I am the Managing Director of Lance CPA Group. We are a CPA firm that specializes in preparing or working with craft breweries and doing their accounting, tax, payroll, compliance, and advisory services for them. So we are excited to present this topic here today, particularly in light of all the changes that are coming into play here, which we will cover in this webinar. So we'll touch on all that and go through that. If you have any trouble hearing us or hearing me or any issues with the webinar, please put that in the chat screen on the right-hand side there, and we can make those adjustments there. But we're excited for you guys to join us here. We'll give it another minute here to let some more people come in, and we'll get started here shortly. Also want to let you know as well is this is going to be recorded and posted to our YouTube channel later here today. So if you want to review it at a later time or share it with some other colleagues, you're certainly able to do that as well. All right, we are going to go ahead and get started here. So again, welcome to our end of year tax plan for breweries webinar. My name is Josh Lance. I am the Managing Director of Lance CPA Group here. At Lance CPA Group, we don't feel like we're doing our job unless yours is getting easier. And what that means is if we're doing what we're supposed to be doing, we are ultimately making your job as a brewery owner easier as you run your brewery and your business. And we get your business. Your business is beer. Last thing you want to do is spend your time managing your company financials. After all, your job is to create killer recipes, source the best ingredients, and brew your phenomenal beer to continue to impress your customers. And at Lance CPA Group, we understand and support this focus on your brewery. We know what it takes to run a craft brewery and feel confident about the expertise we can bring to the table here. And we can help you from everything from outsourced accounting, bookkeeping, tax, payroll, general advisory, forecasting, you name it. We are here for you guys. Okay. Some housekeeping notes here. This webinar, again, will be recorded and posted to our YouTube channel later today. The brewery benchmarking, we'll post to our channel later today. We will also post it to our website as well, so it is available for you there. Another thing we want to let you know about is our brewery benchmarking event on January 23rd. At 9:30 a.m. at the Board and Barrel Restaurant in Naperville, Illinois. This event is something we're really excited about. What we're going to do is we're inviting breweries to participate in this event. We'll take their data, anonymize it, so it can't be known what your data is and shown to other breweries. We'll take that data, anonymize it, pull it together with other data from other breweries, basically, and provide some benchmarking data and analysis and KPIs to really kind of see where kind of state of the craft brewery is here in Chicago and elsewhere, and as well as to compare your data to the benchmarking group so you can get insights on how you are faring when it comes to financial and non-financial data. Yeah, so we're really excited about this. You can sign up for this event at the website bb18.lancecpa.com. They'll have a little bit more information about what's going on with that event, and you can sign up there. It's a free event. The one thing we do ask is if you do participate in the event, that you are willing to share your data with us. And again, we'll keep it anonymous and confidential as well. And also, any questions you have, go ahead and post them into the box here. There's a chat box here, and so if you have any questions or anything, feel free to post those, and we'll answer questions throughout the event as well as at the end as well. All right, so our agenda here. When we initially put this event on the calendar a few weeks back, we were really planning on doing this as a really kind of discussion of what, kind of things to do from a brewery perspective here at the year end to kind of get things optimized from a tax perspective. And then, as everyone's probably well aware of now, there is a new tax legislation that's being put in place, most of which is effective for 2018, although there's a few items that are effective once the bill is signed. And that really changed our approach here for this presentation. So our agenda is really going to talk through what new tax legislation is coming down the pike here, particularly in how it relates to craft breweries. We'll talk through some end-of-year planning opportunities that we have for the remaining days here in 2017, as well as then talk about, okay, what does this mean for 2018 and beyond from a planning and strategic perspective when it comes to taxation and ultimately how you run your brewery. So let's first start with the new tax legislation. This has come down here. We got the final conference bill late on Friday. I got to spend my weekend reading said bill. And so here, this kind of shares some of the highlights here. The bill has now been passed by the House and Senate, and it sounds like from everything I'm hearing will be signed into law tomorrow. So what does this mean here for craft breweries? Basically, there's kind of 5 major changes I think will most impact craft breweries. One is reduction in excise tax. The other is the pass-through tax deduction. Depreciation changes, elimination of the Section 199 deduction, and elimination of the entertainment expense deduction. So the reduction in excise tax. So this is something that's been bandied about a bit here in the past few years. There were other pieces of legislation that were trying to get to this result. Eventually, the Brewers Association, representing the craft brewery needs, worked with the industry groups related to the larger breweries, and were able to get this into the tax bill here. And what does this mean? So for small brewers, which is defined as brewers who produce less than $2 million or 2 million barrels annually, you have a reduction in your federal excise tax on the first 60,000 barrels from $7 per barrel to $3.50 per barrel. And then from the 60,001 barrels to 2 million barrels, it's reduced from $18 per barrel to $16 per barrel. So ultimately, it's a 50% cut in the excise rates. For all other brewers, so your larger brewers, the ones over 2 million barrels annually, they're getting a small cut as well, going to $16 per barrel for the first 6 million barrels, and then back to the $18 per barrel rate thereafter. So what does this effectively mean for a brewery? So in this example here, Brewery XYZ produces 3,000 barrels per year. The excise tax in 2018 would be $10,500 instead of $21,000. So effectively, you get a in this case, it would be a $10,500 tax break. Now, what is important to note here is this is only applicable for the 2018 and 2019 tax years. It will expire December 31st, 2019. So in 2020, we go back to the rates as they were unless this gets extended. I'm guessing there's going to be a push for this to get extended here, but again, it's not guaranteed, and it may result in that. So for your planning here for the next 2 years, you are going to get this this rate decrease out there. So that's kind of the first big one, and really specific to the craft brewing industry. The other big one here, one of the most probably fundamental changes to current tax law that was passed as part of all the changes was the pass-through tax deduction. So taking a little bit of a step back here, the businesses that are taxed or are a pass-through tax business. So that would be basically anything that's not C Corp. So your sole proprietors, your partnerships, your LLCs, your S Corps, your LLCs taxed as S Corp. Those entities, those business entities, and really all the breweries we work with are a pass-through tax entity, whether they are a LLC taxed as a partnership or an LLC taxed as an S Corp or an S Corp directly. Those businesses have always been taxed on the individual tax rate structure. So the tax rates that are paid by individuals, also the income that's generated from these pass-through businesses falls under that taxation standard versus the corporate taxation standard. Now, in this tax bill, the corporate tax rate was reduced to 21%. And so they had to do something with the pass-through tax entities or pass-through entities in order to make it somewhat equitable. And when they've done tax cuts in the past with related to businesses, it's always been on the C Corp level. And it really has never touched the pass-through entities. And so this is really kind of the most fundamental change in this bill from a purely taxation structure is this pass-through deduction. And so what this does is the flow-through income to each owner, partner, and member is now subject to a 20% deduction. So for example, if XYZ Brewery had 2 equal owners and had $100,000 in net income, as normal or as usual, each owner would receive $50,000 through a K-1 statement, which would be reported on their 1040. And starting in 2018, now each owner will also receive a deduction equal to 20% of what gets passed through to them. And so in this case, they would obtain a $10,000 deduction. If that's all it was, that'd be great. But there are some limitations in place. So the way those limitations are structured are based on whether the business is a goods business or a services business. And so, for craft breweries, the services business limitation isn't meaningful. But if you have other entities that you own or your spouse is part of a service business that receives a K-1, one of the things to consider here is any qualified business income over $157,500 for single taxpayers or $315,000 for married financial joint taxpayers is subject to a phase out of that deduction over an amount of $50,000 for single or $100,000 for married final jointly. And then after you get past those levels, so really that's $207,000 for single and $415,000 for married final jointly, the deduction goes away completely. So if you fall in that part, you don't get the deduction at all. Period. Not even on the amounts before the 157 or 315 limits. Now that's for services-based businesses, with the exception for architects and engineers. Those two services were actually scoped out and fall under the goods-based business rules. Now for breweries, which fall under the goods-based business rules, there is another limitation as well. And that limitation is for, again, using the same thresholds of 157.5 for single or 315 for married final jointly. You get a limitation which is based on either the greater of the 50% of your W-2 wages or 25% of your W-2 wages plus 2.5% qualified property. And also to note, these limitations consider all taxable income. So if we go back to that first example where it was only $50,000 flowing through each to each owner, but the owner also has other income that gets them above that level, these limitations apply. So it's not just the income from the business that can put you over the threshold levels and receive limitations. It's all taxable income that the taxpayer has. So let's talk through an example where this limitation is in place. Let's go back with Brewery XYZ has our two owners. Instead of the $100,000 in net income, they have $1 million in net income. That'll be equally split and passed through to its two owners. Brewery XYZ has $200,000 of W-2 wages and $300,000 of qualified property, which will both be split equally for the purposes of this limitation. So each owner would see the following deduction. So first we have to calculate what deduction is before the limit. So they are going to get, each owner's going to get $500,000 passed through to them on their K1 statement. And so if the limitations weren't in place, they would receive a $100,000 deduction. However, now we have to look at what the limitations are. And if the limitations amounts are in excess of the initial deduction, then we take the initial deduction. If they are less than the initial deduction, then we have to take the greater of those two calculations. So in this case, we first look at the 50% of W-2 wages. So each owner is going to get $100,000 of wages allocated to them. And these W-2 wages are not their W-2 wages, it's the W-2 wages of all employees. So it could be theirs and, all the taproom staff or assistant brewers or things like that. It's not just their W-2 wages, but they're getting that allocation of all W-2 wages for the purpose of this calculation. So it'd be 50% of the W-2 wages, which is $100,000 that they were allocated each. 50% would be $50,000, or they can do the alternative calculation, which is 25% of W-2 wages plus 2.5% of qualified property. And that calculation would come out to $28,750. So the deduction now that they're able to take is limited to that $50,000 or the from that 50% of the W-2 wages. So ultimately now their effective deduction was 10% and not 20%. So that can, as breweries grow and have more net income, that may come into play where this pass-through deduction that you may have received in earlier years now in the future years is somewhat limited. And it is important to note that C Corps are taxed at 21% flat rate across the board. And these limitations and things don't apply to C Corps. This is only for pass-through companies. And we'll talk a little bit more later about what does this mean from an entity perspective for your brewery and how does that maybe potentially change your entity structure. So we'll talk about that a little bit later. Another big key changes are depreciation changes. So obviously breweries have a lot of capital property, equipment that they own. And depreciation rules are helpful because, particularly in ways we can accelerate the depreciation, that can limit taxable income in early years and basically save that money to reinvest in the business or hire additional employees or do additional things for the business. So what are these changes with the new bill? One is Section 179 limits. Right now, your limit for doing a Section 179 expense in a given year is $500,000 with a phase out at $2 million. That is now going to be increased to $1 million with a phase out of $2.5 million. So ultimately, that means we can do more or have more equipment qualify for that Section 179. Another thing that we get to do, and this is one of the two changes in the bill that are actually effective now and do not wait until 2018, is bonus depreciation. So new qualifying depreciable assets can now be 100% expensed instead of the 50% expense under the bonus depreciation rules from now until December 31st, 2022. And so what does that mean from now? So basically there's a date set, which I believe is September 21st. So any qualifying depreciable assets purchased after that September 21st date can now be utilized for this bonus depreciation and be basically 100% expensed when bought. So ultimately that's a real good reason to accelerate stuff there. Now there needs to be some sort of planning with that, because what we don't want, and particularly in partnership taxation, if you're filing a 1065 tax return, is to have that, is to take bonus depreciation in excess of your taxable income, because basically we're wasting dollars at that point. So we don't want to do that, but in cases where we have taxable income and we really want to reduce it now, we can do that. We'll talk a little bit too how that can play for 2017 tax planning a little bit later. And the third one, which is I think going to be really helpful for breweries who are looking to do some build outs or some leasehold improvements, is now what they now have basically deemed, or what they're calling qualified improvement property. So this is leasehold improvements, this is restaurant improvements. We now are allowed Section 179 expensing for these. So previously they were 15-year assets. We could do special depreciations, but we couldn't do Section 179 on them. They didn't qualify for that. And so they would end up, you get some sort of special depreciation, but then you're basically taking that amount you paid, which can be significant, and depreciating it over 15 years, typically on a straight line basis. Now we are able to do that, take that property, those leasehold improvements, and utilize Section 179 expensing for that, which again is another good plan and opportunity that arises from this. One thing that was eliminated, and I think a lot of breweries, or most breweries, should be taking advantage of, or should have taken advantage of now, is the Section 199 deduction. So Section 199 is the domestic production activities deduction, also known as DPAD. That 9% deduction is going away. So 2017 is the last year you can use it. The new law removes it, and part of the reason for this is the pass-through tax deduction is really kind of an amplification of the 199, and it's actually the pass-through deduction is part of Section 199A, so it's really kind of this amplification of what 199 was initially trying to get at, and some of the definitions and things were carrying over from that as well. That deduction is going to go away, and it's basically thought to be replaced by this new pass-through tax deduction. There was a question on the 179 leasehold improvements from the previous screen here. Those 179 improvements, or Section 179 expensing for leasehold improvements, don't start until January 1st. That's only the bonus depreciation that started September 21st. Most everything in this tax bill is a January 1 start. Bonus depreciation was one of two items that was a earlier start. The other one with the earlier start, or it's applicable for 2017, relates to medical expenses on for itemized deduction purposes. You used to have medical expenses in excess of 10% of AGI. That was reduced to 7.5% of AGI. So that was the only thing those two were the only thing that were effective now, effectively. Everything else that we talked about with the new tax law is going to be effective in 2018. All right. Elimination of entertainment expenses. So previously, meals and entertainment expenses were deductible at 50%. So if you spend $100 in meals and entertainment, you basically can deduct 50% of that, or $50 on your taxes. Now that entertainment expense deduction is going away entirely. So any amount spent on entertainment expenses, so you take the team to a sporting event, you host some sort of party, those expenses are not deductible. Meals at the entertainment event are still deductible at 50%, but the entertainment event itself is not deductible. So it's important that if you do encounter these expenses, that the entertainment part is differentiated out from the meals part. And I would suspect, because this is going into play, the entertainment expense deduction was widely used, particularly in the corporate sector, that you'll start to see things like, maybe you were going to take, your team to a Bulls game, and the Bulls structure the event. So we'll give you the suite for free if you buy food at a significant price increase. And so I could see that there be some game into the system there, but again, it's important to note that the entertainment expense part is going away. So just keep that in mind for 2018. So let's talk about 2017 plan opportunities. And before I get to that too, there's a lot of things we didn't cover as far as the new tax law. The points that I cover really more the ones that are be effective towards for breweries. There's a lot of changes to individual things too, which again, if you're in the pass-through entity, and you're getting that pass through on your individual return, obviously those individual things come into play. One question that we did get, I got today, was relating to, this is really for partnerships. Unreimbursed business expenses were in the partnership taxation. You can actually take that deduction against on your Schedule E as an unreimbursed expense. That's still allowed. However, the unreimbursed business expenses that you would take as part of a 2% of AGI calculation on your Schedule A itemized deductions is gone. So if you were doing that where you were doing it on your Schedule A, that part's gone, but the part on Schedule E still remains. So it's an important note of clarification there. So, all right, so 2017 plan activities. There's a few days left, namely 10 days left of the year. What can you do now that will impact you here? So there's really two kind of levers you can pull here while there's still time. And one is depreciation on the 2017 new equipment purchases, and the other is acceleration of expenses. So let's talk about the depreciation piece first. Usually when we work with breweries, we advise that anytime we get new equipment purchases or anything that we can do a Section 179 deduction on, that we do that. And the reason being is Section 179 allows you to accelerate the expense, but also allows you to defer the expense as well. And what does that mean? What that means is you can only take Section 179 deductions to the extent that you have taxable income. So if you let's say ran a loss for that year from a taxable income perspective before we get to depreciation, that Section 179 deduction that you take, basically you're disallowed to take, but you carry forward that deduction in future years until the point where you do have taxable income and you can offset. So generally when we talk with breweries, we advise on that path because it allows us to control that depreciation and not get stuck depreciation over a 7-year period. It also allows us to avoid taking depreciation in excess of taxable income, which I'll talk about here in this next point, why we don't want to do that. But that's generally our best bet. So if you are making 20 purchases or if you had made purchases of equipment in 2017, we want to make sure we 179 those to the extent we can. We also want to, if you're looking to maybe potentially make a purchase of equipment in early 2018, to the extent that you can do that and accelerate that into 2017 would be preferable. And that gets down here to the next point here is that going back to that bonus depreciation or the 100% expensing that we're able to do now for effectively purchases in the fourth quarter of 2018, we can do some tax planning where depending on where our taxable income is going to end up at, we can maybe take some of the assets we bought in 2017, particularly ones we bought in the fourth quarter, and utilize the bonus expense or the bonus 100% deduction with the new law to the extent of taxable income that we have. And then for all other assets, do 179 on it, so we can basically accelerate and defer. And why I say we don't want to take the bonus depreciation or the 100% expensing that brings us in excess of taxable income or creates taxable loss if we do that, it is really because when we do that, particularly when we have investor owners, and I know a lot of breweries I work with may have a handful of owners that are investors in the business that are passive owners. When we do the bonus depreciation or the 100% expense in excess of the taxable income, we can run into a situation where we're now creating losses and passing that through. which is, for a passive investor, it may sound great because we can, hey, I get to take some additional losses this year, offset some of my other expenses or income that I have. But the issue that run into is if we do that, then we're not utilizing that depreciation deduction in the years where we do have taxable income or offset there, which ultimately will cause almost an acceleration of the point where you will have taxable income. And at that point, typically in a pass-through entity business, you're going to make tax distributions to help cover the taxation you're passing through to your owners. And if we had, taken a bunch of depreciation and caused a bunch of taxable loss from that depreciation in earlier years, that's really cash in our pocket that we're kind of giving away, because that accelerates the point in time where we have to make tax distributions to our owners. And we really can't go back to our owners and say, well, by the way, 2 years ago, we gave you some bonus depreciation that reduced your taxes. Those dollars that you save there, you should apply it to this tax bill now 2 years later. That's going to be a hard conversation to have with some owners and investors, and that can really cause some issues there. So we want to be careful when it comes to not doing bonus depreciation or 100% expensing in excess of our taxable income. The one thing we do want to push off until 2018 is leasehold improvements, because we can do Section 179 on it. So, if you're a cash basis taxpayer and it's a matter of, making that payment on some leasehold improvements now, or make it January 1, it may make sense to make it January 1, because we can do a little bit more from a depreciation perspective than doing it now and have to, take that leasehold improvement and push it for 15 years. So that's something to consider there. There are things, acceleration expenses. So all things being equal, the new tax bills will lower tax rates for business and individuals across the board. So if I made $100,000 this year for my business, $100,000 next year for a business, again, all things being equal, I'm going to be paying less taxes in 2018 than I am in 2017. So if I know I have planned purchases in early 2018, it'd be good to accelerate those now, because that deduction I get from that planned purchase carries a little bit more weight in 2017 than it does in 2018. So usually, the acceleration expenses is usually a tax plan strategy that always gets talked about. And most years, I'm pretty ambivalent to it, just because we're kind of basically just moving, money between one year or another, and we're not really changing our overall tax perspective. But in this case, where we actually have a tax cut coming here in 2018, it is better for us if we can accelerate some purchases in 2017 to lower that bill. So, you see a lot of some of the big corporations, AT&T, Comcast, announcing bonuses for employees, and they're going to pay those out now. A big reason for that is that bonus carries a bigger tax benefit now than if I paid those dollars out in 2018. So you'll see, some companies particularly make that, or, if you have salespeople where you're paying some bonus or commission, you may want to accelerate some of that if you can now. So maybe it's a commission payment that you would have made January 2018. To the extent you can make it December 31st, that may be worthwhile. All right, so let's talk about 2018 beyond here. So with this new tax law in place, the thousands of pages of tax law that are being passed here, ultimately there's going to be some time for kind of the reviewing and determine, okay, what does this all mean? What does it say? What's the best impact and benefit to our business? And there is quite a few things in there that will probably need some technical correction or further guidance from the Treasury Department on how you actually implement it. So I don't want to talk about some of those kind of minutia type things right now, but I do want to talk about some of the bigger things that either are being discussed in the news or in various industry groups on what is the best benefit, or what are some tax planning strategies for 2018 and beyond there. So the three that I want to talk about are legal entity changes, or at least entity changes from a taxation perspective, employee conversions, and depreciation changes. So the first here is entity changes. So like I said, we have this pass-through tax structure deduction that was implemented here that kind of fundamentally changes how pass-through tax entities are being taxed. With that being said, we also now have the C Corp tax rates down to 21%. So depending on your income from the business being passed through to you and all other income sources you may have, you may lose or not receive a significant deduction from that pass-through deduction. So as we talked about before, we may get limited out of things depending on what our W-2 wages were paid to employees or what qualifying property purchases they were in that year. So the question comes, should we change or convert our status? And so this was actually brought up 2 days ago from an article on Good Beer Hunting, which talks about the tension between craft breweries and the excise tax and all of the tax changes there. And it was mentioned that maybe breweries will change to a C Corp status, convert from that. So making a entity change is a pretty big deal from a taxation perspective. And it's not something you just do lightly or do something you do because it makes sense now. You really have to kind of look at the long-term perspectives of it. So, and reality is what the changes would be your LLC or your partnership decides to become a C Corp for tax purposes, or physically converts to a C Corp in a new entity structure, or your S Corp converts to C Corp as well, or your S Corp may decide to revoke its S status and be taxed as a partnership or single member LLC. So there are some things to be aware of. One is conversions may trigger some tax consequences. Notably, an S to C conversion has some tax consequence triggers in here. In the tax bill, this was actually kind of thought through. And really, if you kind of read what's in the tax bill and what's been discussed, in tax reform for the past few years, there's been some push in some sectors to eliminate or reduce the utilization of the S Corp. And the utilization of the S Corp is, or why a lot of companies utilize S Corps is to take advantage of not being taxed from a self-employment tax perspective on the net earnings of the business that flow through to its owners. However, there now may be this wave of conversions going back to C Corps. So prior to 1986, you had a lot of people become Cs. After 1986, with the tax reform that happened then, there's a lot of S conversions. We may be seeing, some reversals of that. But the S to C Corp conversion does create tax issues, and the tax bill actually identifies those and provides some relief there. So any taxes that were owed from the conversion can basically be paid over a 6-year period. So there is some relief there, but that's really, if you're going to do that relief, that's a 2018 item. It doesn't sound like that's something that's going to be extended past 2018. But there are some tax consequences there if you do that type of conversion. Also, the other thing to be aware of is if you are a pass-through tax entity, either an LLC partnership or S Corp, you can make distributions to the individual owners, and that doesn't carry additional taxes for doing that. However, in the C Corp structure, if you make those same distributions, those distributions are then subject to taxes on the individual as dividend taxes. So if you were in a situation where you're receiving a small W-2 salary and you're getting some sort of tax distribution or other distribution towards yourself, or your partners were getting a tax or getting a distribution, in a LLC or a partnership or an S Corp structure, there wasn't an additional tax on that. In the case of a C Corp, there is. And that really kind of gets to some double taxation issues there. So that's something to be aware of as well. Ultimately, conversion should be thought in the long term. It's really kind of frowned upon in the tax code to make a conversion, each year, right? So you can't just convert to a C corp in 2018 because that makes sense, but then in 2019 you're convert back to an LLC because that's better for you. Once you kind of do conversion, you're kind of stuck with it. So it's you don't want to have a short-term view of this, we want to have a long-term view. And ultimately, there's going to be additional guidance questions that are going to be forthcoming from the Treasury Department and from Congress with regards to this. My take on this is if you're a goods-based business, that it may, unless you have significant income for your business, it may not make a whole lot of sense to convert, that you're probably best staying as is, particularly if you're an LLC, Texas partnership. There isn't a whole lot of reasons to make that conversion. If you're a service-based business, you'll probably see more of those convert to C corps. But from a particular brewery perspective, I don't expect to see a lot of small breweries or craft breweries do that, unless there were particular reasons. Maybe it's a closely held business where you don't have a lot of investor owners, and maybe there are some other individual taxation issues and there's some other businesses you own or things like that that may play into that. So when you look at this decision to do an entity change, you got to kind of look at it, globally from your perspective and your other partners or owners' tax perspective, as well as from a long-term basis. So again, I don't suspect to see, much of these changes happen now, but it's not to say that they won't happen here in the future. The other one that's been talked about a bit is employee conversion. So with the new pass-through tax laws in place, it makes a lot of sense from an employee perspective to be taxed or classified as an independent contractor and not an employee. And the reason for that is they can basically take that income as a single member LLC or sole proprietor. They're going to get that pass-through tax deduction if they're below the thresholds. As well as if there's any unreimbursed business expenses, they're able to deduct that there. Like I said before, on Schedule A, where normally an employee would deduct unreimbursed business expenses, that deduction is now gone. So unreimbursed business expenses are no longer deductible on Schedule A. And so from an employer perspective, particularly they have that, and usually it's if someone's in sales, that typically is where they have that. It may make a whole lot of sense to be an independent contractor because you're going to be paying potentially a whole lot less in taxes by going that route. However, it's important from an employer perspective that you follow the IRS 20-factor test on the employee versus independent contractor determination. And why it's important for you as the employer is if the IRS comes back a year, 2 years, 3 years later and says, that person that you are now paying as an independent contractor really meets the definition of employee and the IRS 20-factor test, not only will they make you reverse that, but they will make you basically go back and pay back tax and penalties and interest, and it's pretty steep and severe. So I would advise if there was going to be this decision made for an employee or employee groups in your company, that you get some advice there. Talk with your CPA, talk with your attorney or employer law professional. We'd be happy to talk to you about it as well, because you want to make sure you're still following the rules and not just allowing your employees to become independent contractors because of this pass-through tax deduction. I think also interesting too. This is totally unrelated to breweries. That from like the Uber perspective, where Uber drivers are trying to get employee classification versus independent contractor classification so they can obtain benefits. Now you may see that idea reversed a bit because with the new structure in place, it may be better to be an independent contractor. We have another question with regards to this. So to receive the preferable tax situation, the employee would still need to be organized as a pass-through corp rather than file Schedule C. The answer is no. They can file Schedule C for this. So they can just be a sole proprietor and file Schedule C. If they wanted to become a single member LLC and file Schedule C, that's fine. Or they could become an S corp and do it that way. That works too. So they can do Schedule C. This deduction works for Schedule C taxpayers. And those Schedule C taxpayers will get the 20% tax deduction. So that's why this becomes this real question of, do you have employees who want to become independent contractors because of this? Because they're basically going to get a 20% deduction off the bat, and even though they're going to have to pay, effectively the employer side of the payroll taxes, that's still going to be, a small. It's going to be an offset, but not a big offset to the tax savings they're going to get there. So. So it's something to think about. So you may get employees ask, hey, oh, by the way, can I be an independent contractor? You want to make sure that, they're in a role that it makes sense for and follows the IRS 20-factor test. Because if the IRS determines that classification to be wrong, it's not the employer independent contractor that gets faulted, it's the employer that gets faulted. So, so something to consider there. And the third is depreciation advantages. So we get to gain the ability to do Section 179 deductions on leasehold improvements. We gain the 100% expensability with bonus depreciation. We also get a greater limit of Section 179 in total, and we can also manage that with Section 179 deferrals. So in a lot of ways, there's some significant depreciation advantages here for this. And so it's important as you plan, if you're growing, you are building up your brewery, maybe you're buying some more equipment, taking some of the savings and excise taxes and buying more equipment and things like that, then we really look at the depreciation advantages and get that structured appropriately. Because there is a lot that can be done here with regards to that. And it's important, again, to make sure we structure things appropriately there and are doing the bonus depreciation or the 100% expensing when it makes sense and doing 179 when it makes sense. Particularly now with the Section 179 on leasehold improvements, we may, trigger to do those first, because we want that beneficial taxation there, versus, maybe equipment purchase where we may do a bonus depreciation instead. The other thing in there that was done from a depreciation perspective is also, if you're making a buy versus lease decision on an automobile, whether that's it's a truck or a van for the brewery, or even a car or something like that. The depreciation structure that's now in place actually makes it probably more beneficial in most cases to buy the car versus lease the car. Whereas in the past, it was a toss-up, kind of depending on your facts and circumstances. You can go either way. You're kind of being, push more towards the buy option. And it's the same thing that goes with equipment too. So there's a lot of people who will, do leasing in place for equipment. And in 2018 going forward, it may not make sense to lease equipment just because of the way depreciation can now be structured. So that is a particular advantage there. So yeah, that is our presentation here. Again, I want to tell you about the brewery benchmarking event, January 23rd, 2018 at Board and Barrel in Naperville, Illinois from 9:30 to noon. Again, if you are interested in that, it's bb18.landcpa.com. Again, bb18.landcpa.com. It has more information, and you can register for it there. For those that have registered or will register, you'll be getting some information here at the beginning of the year that basically, says on our end that we will, keep your information confidential, and that, and anonymize any data that we get from you when we use it for the benchmarking purposes, as well as start to get some additional information for you, particularly on some non-financial items, to allow us to give us, the best information to you as possible. And so with that, I'll take some questions here. If you have any questions, now is the time. We'll leave this open for some questions. We will also be doing another webinar here in early January that kind of goes through all the individual tax changes. that will impact you from an individual perspective beyond just that pass-through tax deduction. So if if you're interested in that, watch out for that on our Facebook page or on Twitter or on our website, where we will have that information available for that webinar in January. We also will have in their webinar in January, they'll talk through some of the other corporate tax changes, not just from a brewery perspective. So that is forthcoming here as well. Again, any questions you have, feel free to type them in that chat box now, and we will answer those. I'll leave it open here for another minute or two for those questions. Again, if you need information on us, visit our website, lancecpa.com. We have some blog posts there relating to some of the tax law changes, as well as some other things that would be of interest to you from a brewery perspective. You can also find our website on the resources link, links to our prior webinars. So the one we did last month was on strategic planning for breweries, particularly related to some of the macro and microeconomic conditions out there. So feel free to take a look at that. Again, this will be recorded, or this webinar has been recorded and will be posted on our YouTube page here later today. So if you want to read back through this or share with colleagues, you're free to do that as well. It doesn't look like we're going to have any more questions here, so we'll go ahead and close this broadcast up. Again, thanks for joining us here today. If you have any questions here, our contact information is here on this last screen. You can get us at info@lancecpa.com. You can call us at 630-537-0226, or you can reach me personally at josh@lancecpa.com.